Look at this number. This is the total registered silver inventory at the COMEX, the world's most important exchange for trading physical silver. For months, it has been bleeding, ounce by ounce, vault by vault. It has been draining away. And as of this morning, it has hit a level so low, so critically low, that the entire system is now perched on the edge of a knife. What you are about to see is not speculation. It is not a prediction based on hope or fear. It is a cold, hard analysis of the data that leads to one inescapable conclusion. Tomorrow, on what will be known as Black Thursday, the trading of silver on the COMEX will be halted. The system will hit a limit-up event so severe that trading will stop. The market will freeze. And when it does, the price you see on your screen will become utterly meaningless. How can I be so certain? Let's break down the evidence, piece by devastating piece. First, understand the mechanism. The COMEX operates on a futures market. This is a promise to deliver silver at a future date. But behind those paper promises, there is supposed to be real physical metal and vaults to back them up, to ensure that if someone wants to take delivery of an ounce of silver, that ounce actually exists and can be handed over. This is the foundation of the entire system. Trust that the metal is there. That foundation is now crumbling. The registered category you see here is not just silver in a vault. It is the silver that is specifically available and approved to back those futures contracts. It is the deliverable supply. This number is now at a multi-decade low. It is a tiny fraction of the total open interest, the total number of outstanding paper promises to deliver silver. The ratio of paper claims to physical metal available for delivery is now at a level never before seen in history. It is mathematically unsustainable. This is not a gradual decline. This is an accelerating collapse. Each week, the drawdown gets larger. Major entities, the ones who know how the game is played, are quietly submitting notices to take physical delivery. They are exchanging their paper contracts for real, tangible bars of metal and having them moved out of the COMEX vault system entirely. They are not selling for a profit. They are taking the metal. Why? Because they see the writing on the wall. They know a physical shortage is not coming. It is already here. The warehouse receipt, the paper saying you own silver, is only as good as the metal behind it. When the line of people holding receipts grows longer than the stack of metal, the music stops. And right now, the line is wrapping around the block while the stack is almost gone. This creates a ticking clock. Every trading day, the pressure mounts. The algorithms and trading desks operate within rules. One of those key rules is the limit-up rule. To prevent wild, disorderly price spikes, exchanges impose daily price limits. If the buying pressure is too intense and the price tries to rise beyond that set percentage in a single trading session, trading is automatically paused. It is a circuit breaker. Given the catastrophic imbalance between urgent physical demand and evaporating supply, the buying pressure needed to locate and secure any remaining deliverable metal will be explosive. It won't be a rally. It will be a panic. A scramble for the last few bars in the warehouse. That panic will trigger a limit-up move so fast the system won't be able to process it. The halt will be automatic. It will be systemic, and it will happen tomorrow. Why tomorrow specifically? Because the data from today's settlement has just confirmed a critical failure in the delivery process. Several large standing delivery notices were not met with metal. They were settled in cash. This is the canary in the coal mine. When the system starts failing to deliver physical and instead forces cash settlements on unwilling participants, the final stage of the squeeze has begun. The trust is broken. Tomorrow, every remaining participant with a brain will rush to convert their paper to physical before the window slams shut. That tidal wave of buy orders for physical delivery will be the trigger. Now, you might hear the talking heads say, there is plenty of silver in the eligible category. They will point to a larger number and claim all is well. This is a deliberate deception, and you must understand it. Eligible silver is metal stored in COMEX, vaults that is not approved for delivery against futures contracts. It belongs to ETFs, to investment funds, to sovereign nations, or to industrial users who have it parked there for safekeeping. It is not for sale. It is not part of the deliverable supply. It is, for all intents and purposes, invisible to the market's delivery mechanism. Asking where the silver is and pointing to the eligible stock is like being in a famine, pointing to a locked grain silo owned by another country and saying, "See, there's the food." It is meaningless. The only number that matters is the registered stock, and that is the number in free fall. The players who own the eligible metal are watching this happen. They are not stupid. They see the registered vaults being emptied. They know their metal in the eligible category is safe only as long as the overall system has credibility. The moment the exchange halts trading because registered metal hits zero, the entire vault system comes into question. Will people start to wonder if the eligible metal is truly there? Will demands for audits and physical inspections become uncontrollable? The owners of that eligible metal will not want it trapped in a failing system. They may begin to withdraw it, further draining the total vault stock and creating a visual, panic-inducing exodus. This creates a second wave collapse following the initial trading halt. The halt is not the end. It is the beginning of the end. Let's talk about the trigger event. At the open tomorrow, the usual algorithms will engage. But the input data has changed. The key banks and market makers who provide liquidity, who are obligated to buy when others are selling and sell when others are buying to maintain an orderly market, are facing an impossible dilemma. Their short positions, their bets that the price will go down, are astronomically large. To cover those positions, they need to buy back contracts. But to buy back contracts, they need a seller. If the driving force of the market is not sellers, but buyers demanding physical delivery, there is no one to sell to them except at a much, much higher price. They will be forced to bid the price up aggressively to find any liquidity. This bidding war against their own short positions is called a short squeeze. And it is happening in the physical realm, which makes it 1,000 times more powerful. It's a physical squeeze. You cannot create silver out of thin air to settle a bet. You need the metal, and there is no metal. As their bids fail to find sellers willing to part with physical, the price will gap higher. It will smash through the first price limit barrier. Trading will pause. When it resumes minutes later, the panic will have been broadcast to every trading desk, hedge fund, and retail investor in the world. The second wave of buying will be even more ferocious, composed of pure fear of missing out and fear of systemic failure. It will hit the second, wider limit. And then the final halt will be triggered. The market will be frozen. The screen will flash system failure, trading halted. And in that moment of silence, the entire world will realize that the price discovery mechanism for one of the most critical monetary and industrial metals on planet Earth has completely broken down. What happens when trading halts? All buy and sell orders are suspended. No one can get in, no one can get out. The paper market is closed. But the physical market never closes, in the shadowy, over-the-counter physical market, where large bullion banks and institutions trade amongst themselves. The real price will be discovered. And it will have no relation to the last traded number on the frozen COMEX screen. We are talking about a repricing event of historic proportions. So, what does this mean for you? If you are holding paper silver on ETF like SLV, a futures contract, a mining stock, you are holding a claim on a system that is about to publicly break. When trading halts, the liquidity for your paper instrument will vanish. You may not be able to sell it at any price. The ETF will be unable to source new metal to back its shares, leading to a premium or a suspension of creations. The mining stocks will gyrate wildly based on fear, not on the real price of their product, because the benchmark price is broken. If you are holding physical silver in your own possession and you're safe, in a private non-bank vault will be unaffected by the trading halt. You own the metal. You have no counterparty risk. The chaos in the paper market will, after a stunned pause, send a tsunami of demand into the physical market. The premiums you pay over the spot price, which is already a fictional number, will explode. The available inventory at online dealers and local shops will sell out in minutes, just as we saw during previous squeezes. But this time, the supply pipeline is utterly drained. There will be no quick restock. This is the final dip, the last chance to convert your fragile paper wealth into real, tangible, indestructible money before the gate is locked. The action you take in the next few hours will define your financial standing for the next decade. Do not wait for the halt to be announced. By then, it is too late. The system is designed to protect itself, not you. The announcements will come after the fact. Your window is right now, before the New York Open tomorrow. This is not about making a profit. This is about preserving wealth. This is about moving from a system of promises, a system of digits on a screen that can be frozen, devalued, or stolen with a keystroke, into a system of value that has survived every empire, every crash, and every war for 5,000 years. Silver is not just a metal. It is the canary in the coal mine of the entire fiat financial system. Its breaking point is the system's breaking point. The evidence is irrefutable. The registered inventories are gone. The delivery failures have started. The short positions are untenable. The mathematical conclusion is that the market mechanics will force a trading halt tomorrow. Black Thursday is not a possibility. It is a mathematical certainty based on the data in front of us. You have a choice. You can be a spectator, watching in disbelief as the numbers freeze and the talking heads stutter, trying to explain the unexplainable, or you can be prepared. You can secure your foundation outside of this failing system. The time for debate is over. The time for action is now. Go to the reputable dealers. Buy what you can while you still can, at a price that still has any connection to the old world. Take delivery. Hold it in your hand. Because tomorrow, when the halt hits, the world wakes up. And nothing will ever be the same again. The evidence is all here. The question is, what are you going to do about it?